half of these, they haven't been falling long. They're just starting to fall. Half of these are already below 50 in the contraction zone. So it certainly confirms what most people are saying is already an existing recession, at least in Europe, and perhaps a pending one into 2013, if not possibly earlier in the United States. Turn back again to U.S. data. If you look over to the next page. Earlier we were looking at U.S. monetary statistics. This page shows our country's inglorious fiscal history over the last 4 decades. It shows what Congress and the administration have done to ward off the effects of the economic crisis in the past few years. Our budget deficit levels are all down in the $1.3 to $1.4 trillion level. And for the first half of 2012, we, as a country, were borrowing 42 cents of every dollar of government spending. That's a scary number. We're borrowing 42 cents of every dollar our government spends right now. And this graph has to scare anyone but perhaps Paul Krugman. Any of you who read Paul Krugman. At these deficit levels, there's not much more that Congress and the administration can do fiscally. What our leaders are attempting to do is to convince us to spend more, to be happy, spend more. And the next graph addresses that point and that question. How much more can we spend? This is a ratio also. It measures personal consumption expenditures as a percentage of our disposable personal income. And you can see that where we are right now is certainly high relative to the time all the way back to the late 1950s. And it's higher than any other point but that period from 2000 to 2007, which was, as you know, coming off the dot-com boom and the housing bubble. You would expect that with greater rates of spending relative to the amount of disposable income we have, that expenditures like that would lead to greater growth in the economy. If you look at these boxes, you'll see an irony that is just the opposite of what you would expect. You would expect if you get more personal spending, you'll get greater GDP growth. We've seen just the opposite. We are in each category, nominal GDP, real GDP, and growth of non-farm payrolls. When you have spending up in this area, that is the slowest GDP growth and the slowest growth in employment. So it's an interesting economic observation. And page 17 shows the flip side of this coin. Saving obviously has become a low priority. You can see this takes us from the late 1940s to present. Most of these graphs, by the way, are Ned Davis research graphs. They do phenomenally good and excellent analytical work, and they have literally thousands of these things, and I probably review at least a couple of hundred of them every week. This one shows that what we've looked at in other instances, and that shows that we have gone from being a nation of savers down to being a nation of non-savers. Now this is more than just personal savings. This is net national savings. So it includes businesses, it includes government. This is what we, in the aggregate, as a country, do. And just as the growth boxes on the prior page show, as you save less, your growth in GDP, both real and nominal, and non-farm payrolls, is in the worst category. So saving is obviously necessary for capital investment and national growth and employment growth. But we are not savers anymore. And we see over on page 18 how our national turn from savers to spenders has resulted in lower and lower economic growth. I showed this some years ago, and it's gotten progressively worse with the exception of the last little decline in our debt. But this shows nominal GDP. It's a 10-year moving average, and you can see from this period, which is just about when we began to increase our debt at a very high rate, the rate of growth in the economy has declined steadily as the growth in our aggregate debt has increased steadily. It's a very sad picture. Yet both monetary and fiscal policy are adding to our debt loads. Despite considerable encouragement, the next page shows that the consumer might be tapped out. If you look over here, this had started to improve. This is a measure of, it's actually a survey of consumer plans. So spending plans by the consumer within the next 6 months. These are on big items. It's on automobiles up top. Right now, this is the lowest plan to buy automobiles in the last 40 plus years, since 1970. Homes in the middle, we had started to increase, just as we had started here with automobiles, we started to want to buy more homes, and we're dipping down, and it's more than one standard deviation below the mean. We're down in the very low area. And major appliances is the bottom, and where we are right now is almost at the all-time low, which was just slightly before that. These intentions are certainly not designed to keep us out of recession. Let me now turn from a review of fundamental conditions to some technical conditions. Over on the next page, we take a look at global equities. This is Ned Davis Research's combination of, I think it's 42 countries. I'm not positive of that, but I think it's 42. And what they're showing in this top tranche here is just the price progress of their 42 country average over the last, what do we have, about 3 years roughly. And you can see that even, this includes the United States as well, even including the United States, this index through Friday was down 15% from its high to here, and it's a little bit lower over the last 2 days, and so on. We see a little more attractive picture over on the next page. And this comes from, these graphs over the next several pages come from Decision Point, which is a very rich site. It's not an expensive site. I would certainly recommend it to any of you. I think it might only be about $20 a month or something like that, so it's very accessible. So anybody who likes to look at quite a bit of data on a great variety of not only securities types of information, but some economic stuff, it's a very good site, well worth the small amount that they charge for it. And in this group, there are 18 markets that they follow that I take a look at on a daily basis in their graphs. And this is the series of graphs. And of those 18 markets, only 2 of them, the United States and the Philippines, are up from a year ago. So the other 16 are down. And there's another individual stock market, Thailand, that's also up from a year ago. That's a relatively major market. But the vast majority, as shown on the prior page, of the markets are down over the past year. Many of them are down over the past 2 years, and virtually all of them are down since the 2007 peak. As you'll see we can quickly review the other ones as we go through. If you look at the next page, you'll see the